Hello, and welcome to another webcast in our Energy Webcast series. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Renewable Energy Tax Update, a look at President-elect Joe Biden's tax proposals. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to Julie Desimone, Partner and National Practice Leader of the firm's Power, Utilities, and Renewable Energy Practice. Julie?
Thank you. Good morning or afternoon, everybody. For 107, so my name is Julie Desimone. I am the Energy Practice Leader. And for the last 107 years and counting, Moss Adams has been a fully integrated professional services firm dedicated to assisting clients with growing, managing, and protecting your prosperity. With more than 3,400 professionals across more than 25 locations, we work with many of the world's most innovative companies and leaders. Our strength is in the middle market, and it enables us to advise our clients at all intervals of development, from startup to rapid growth, expansion to transition. Through the past decade, we've seen a significant shift in the energy landscape, but to be honest with you, I don't think we've seen anything yet. The energy transition that's going to occur over the next decade or couple of decades, from carbon net neutral requirements to grid modernization, will set the renewable energy path forward into the next century. With that amount of change also comes regulatory matters that will impact our renewable energy businesses. One such impact will be tax law changes. We're already seeing those changes occur. Today we're presenting a renewable energy tax update, but please note this is just an update of what we know at this time, which is nothing compared to what we will see in the coming months and years, especially in the energy industry. At the end of the presentation, we'll provide links to our insights pages that will help you keep your business up to speed on the changes that will be occurring over the coming months and years. Also, stay tuned for future webinars and articles focused on the renewable energy industry. Now I'd like to introduce today's presenter, Eric Rohner, who's a tax partner at Moss Adams. Eric serves both privately held and public companies with a focus on the renewable energy and technology industries. With over 20 years of experience, actually closer to 30, in public accounting, Eric has an extensive knowledge base. During his career, Eric has served a variety of clients ranging from closely held businesses to Fortune 500 multinational corporations. Eric is a member of our firm's tax committee and is also a firm-designated ASC 740 reviewer for SEC companies. Eric, I'm turning it over to you.
Okay, great. See if I can figure out how to advance the slides here. So again, thank you, Amy and Julie, for the introduction. And I also wanted to welcome everyone myself and to say thank you for joining us today. And I hope everyone is surviving the pandemic, that everyone had a nice socially distanced Thanksgiving, and everyone is also enjoying our new normal, working from home. So before we discuss some of President-elect Joe Biden's tax proposal, I think it's safe to say we can call him President-elect at this point. But we wanted to do a little catching up and providing some general background on the tax climate for renewable energy first. Then we'll have a bit of a refresher covering the specific federal tax credits that are targeted at the renewable energy sector. And finally, we'll get to some of the tax proposals. The long-term demand for renewable energy from the general public is at an all-time high. In a significant shift in sentiment over the last few years, the majority of Americans now prioritize developing alternative energy over conventional carbon-based energy resources. Millennials are now a major force. They're the ones that are driving this trend towards social responsibility and questioning the environmental impacts of market goods and financial investments. Folks are also starting to view their 401ks as potential impact investments. More and more, they want businesses to offer socially responsible investment options. You'll even hear new terms like energy justice, which is a takeoff of social justice. As momentum builds towards a more socially impactful mindset, it will increasingly normalize renewable energy as a primary source for our future energy demands. The largest companies in the United States continue to set increasingly ambitious clean energy targets. Some of these companies have huge data centers that consume enormous amounts of electricity. And many of these companies are investing in renewable energy projects to offset and neutralize their carbon footprints. Other companies like Patagonia have pledged to become carbon neutral by 2025, in part because their target market demands more eco-conscious products, but also because younger consumers just want to buy products from socially conscientious corporations. Plus, there are other economic incentives for those companies that implement environmental and sustainable governance models. Federal, state, and local governments have also aggressively set renewable energy portfolio standards, and as a result of these standards, they are under a self-imposed and time-based pressure to diversify their energy supplies, to reduce those carbon emissions. And they'll do that by encouraging investment in renewable energy projects, especially through solar and wind. So where the federal government may decide to phase down incentives, and we'll talk about those phase downs, the state and local governments will step in to backfill the incentives to keep renewable energy investment strong. As an example, as of 2020, California now requires all newly built homes to have solar panels as part of the state's goal to divest of its fossil fuels by 2045. Cities like Berkeley, California, and Brookline, Massachusetts have banned the use of natural gas in new homes and apartments. And the same thing is happening in Seattle, Washington, where they're considering a similar ban. In the last few years, the United States has achieved energy independence, but the backbone of that independence is still based on fossil fuels. As the market transforms away from fossil fuels, it is expected that the demand for renewable energy will need to increase to retain our energy independence. And finally, renewable energy is increasingly becoming cost competitive. It is already estimated that wind and solar resources are an equal or better economic proposition than most fossil fuel resources, including natural gas, especially when you consider the all-in costs, including remediation and asset retirement obligations. Even with a robust long-term demand, expected long-term demand, in the short term, there's little question that the pandemic has caused severe economic disruption in the renewable energy sector. Along with an overall decline in retail sales of electricity, there have been declines in both commercial and residential solar installations. Frankly, we're just using less energy during the lockdowns. I know I am using less myself. Whenever I get into my own car, the battery seems like it's almost always dead. Of course, I rarely have to drive my car now, a far cry from my usual commute, which is an hour each way. So that part of the lockdown is great, and it seems like most of our employees are also enjoying that same thing, staying off the freeways. But folks are also just not inclined to make large upfront capital commitments right now to install solar equipment on their property. We've also seen some wind factory shutdowns, including at Siemens and Gamesa, and just recently Vestas, a large wind turbine manufacturer with facilities here in the U.S., they announced plant closures as well. And storage projects have also felt the impact of the pandemic. Okay, looks like we have our first polling question. I'm going to turn the time over to Julie, and she'll walk us through that.
Perfect. So the question is when will you buy your first electric vehicle? And in this, we're also going to add if it's a hybrid, go ahead and call it an electric vehicle. A, I already own one. B, considering buying one now. C, over the next 5 years. Or D, never. And let me give you a couple of reminders as we get into this. As the video said earlier on, you have to have several of these in order to get the CPE credit. One important thing is to the right of the polling question, there is a submit button. If you don't hit the submit button, the answer will not come through. So make sure you hit that submit button. So you need to have at least 3 of the 4 polling questions in order to get the CPE credit. I also want to remind you that for any of those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We'll also be sending them via email. Amy, how are we doing with the polling question?
It looks like almost everyone has had a chance to submit, so I will go ahead and show the results.
Interesting.
Okay,
Eric?
that's interesting. Yeah, thank you, Julie. Really, this question isn't a technical question, obviously, but it's more to gauge interest, and it also kind of confirms some of the things that I'm seeing. It looks like there's a pretty substantial amount that already own cars, electric vehicles, considering buying one. I'm putting myself in that camp as well. But for sure, in the next 5 years, I expect my next car will be an EV. But it is interesting to see that there's also some nevers in there. And I guess that's not very surprising. But if any of this is surprising, I'd just say hold on to your hats. From my perspective, the acceleration to social responsibility and the push to clean, green, and anything renewable is pretty amazing. Just in the last few years, the acceptance of, let's say, only using reusable grocery bags or the elimination of single-use plastics like water bottles is pretty astounding and mostly driven by the younger generation. But the boomers, they're catching on as well, and they're the ones that are driving the Teslas. You know, everybody has LED lighting in their homes and in their workspaces. there's a, everybody has efficient HVAC systems, water efficient landscapes, smart appliances, smart meters in the home. Everybody, wants hookups for their EV in their garage. We're even seeing, tiny houses and things like that. And many of these things really are becoming the norm. So I just expect this trend to continue. And it's really catching on. Again, started kind of with the younger generation, but really moving, across all demographics. Okay, on this slide, we're going to go over a quick recap of some of the recent tax legislation affecting renewable energy and kind of just give us a, where things sit right now and how they got there. In 2015, President Obama signed the Protecting Americans from Tax Hikes Act, or the PATH Act, which reinstated the renewable energy credit that had expired for wind and solar. But it imposed a multi-year phase-out schedule on those credits. Under the PATH Act, some forms of renewable resources were left out in favor of wind and solar. Then in early of 2017, the new Trump administration and Republican-controlled Congress began signaling that they might pursue a less friendly path for renewables that Obama had sat out on as part of tax reform. In some of the early tax reform proposals, existing wind and solar specific incentives were largely eliminated in favor of, broader based, less lucrative, renewable energy based incentives. There were factions in Congress that backed some of these early proposals, claiming that wind and solar industries had matured to such an extent that these resources no longer needed the same level of federal subsidy. And there is some truth in that. These are largely now mature and increasingly competitive resources. But in December of 2017, President Trump signed, the first major tax reform in a long time, commonly referred to as the Tax Cut and Jobs Act, TCJA, and we'll refer to that in this presentation as tax reform. Fortunately, through a series of compromises in Congress, tax reform was signed into law, largely leaving the PATH Act intact and continuing the credits for wind and solar. Then in 2018, President Trump next signed the Bipartisan Budget Act, or the Budget Act. While the PATH Act and the tax reform neglected many resources of renewable energy, the Budget Act did finally extend some expired energy-related tax credits to some of the nearly forgotten non-wind and non-solar renewable resources. In late 2019, a tax bill referred to as the Green Act was introduced to extend and even expand many of the renewable energy tax credits and incentives that were set to expire. While there appeared to be bipartisan support for extending these incentives, the eventual spending and tax bill signed by President Trump in December of 2019, called the Extenders Bill, largely ignored the provisions introduced in the Green Act. The most significant exception to that was for the wind energy production tax credit. And whereas wind projects were subject to a phase down that included a reduced PTC rate of 40% through the end of 2019, under the Extenders Bill, wind projects whose construction began in 2020 were eligible for a 60% PTC rate, while retaining the 40% rate for 2019, and for projects that began construction in 2019. And then in 2020, as a result of the coronavirus pandemic, President Trump signed the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act. Although a detailed analysis of the CARES Act is beyond the scope of this presentation, and there are several other presentations that you can find on our website that go through that CARES Act in detail, we'll discuss some of the more significant CARES Act provisions that at least indirectly benefit the renewable energy sector in the next few slides. Again, although the CARES Act did not address renewable energy policy directly, it did provide provisions intended to ease the economic impact of the pandemic, and it did create a window of opportunity for investors to invest in renewable energy projects. In addition to providing healthcare support and economic relief to businesses and workers affected by the pandemic, the CARES Act also offers tax relief to corporate and individual taxpayers. There are 4 key provisions, and we'll go over those quickly. These provisions include the 5-year net operating loss carryback, the 80% NOL limitation suspension, the postponement of the excess business loss, or EBL, limitation rules, and an increase in the limitation amount for deducting interest expense. So tax reform, as everyone is aware, contains really sweeping changes to the federal tax code that did have an impact on the renewable energy sector. One of those changes from tax reform was the disallowance of the net operating loss carryback rules. However, under the CARES Act, corporations and individuals that generated NOLs in 2018, 2019, and 2020 can now carry those NOLs back to the 5 preceding tax years. The idea with reinstating temporarily reinstating the NOL carryback provision was to quickly infuse cash into taxpayers' pockets by allowing these carryback claims. The ability to carry back NOLs as far back as 2013 can be extremely valuable, especially for corporate taxpayers. The maximum corporate tax rate applicable to years ending before 2018 was 35%, compared to the current rate under tax reform of 21%. So that's a 14% rate arbitrage on deductions that result in NOLs that can be carried back. For individual taxpayers, the 5-year carryback provides a unique opportunity for investors to take tax off the table in those earlier years and to receive immediate cash refunds. In addition to disallowing NOL carrybacks, tax reform also imposed an 80% limitation on NOLs arising in taxable years beginning after 2017, so 2018 and forward. Under tax reform, the NOL deduction in any post-2017 year was limited to 80% of taxable income. The CARES Act temporarily repeals the 80% taxable income limitation for tax years beginning before 2021. So individual investors already had to navigate the passive activity loss limitation and at-risk rules when investing in renewable energy projects. These rules created substantial disincentives for individuals and closely held investors to invest in renewable energy projects. Corporations are not subject to these rules, and that is why you see that the tax equity space is mostly dominated by corporate investors who have lots of taxable income and lots of tax appetite. Tax reform created a new layer of limitation for individual investors, disallowing losses in excess of $250,000 or $500,000 for joint filers. Those are the excess business loss limitation rules that applied to tax years beginning in 2018. However, under the CARES Act, the excess business loss rules are suspended for individual taxpayers for tax years beginning before 2021. And that includes retroactive suspension of 2018. So if a taxpayer was limited under the EBO rules in 2018 and filed a return that way, they can go back, amend that 2018 return, and claim those losses under the CARES Act. The passive loss rules and the at-risk rules continue to apply. Tax reform also created a new limitation on business interest expense that applied for years after 2017. The limitation was generally the excess of interest expense over 30% of a taxpayer's adjusted taxable income, or ATI, through 2021. ATI is computed as taxable income before interest, depreciation, and amortization, generally making ATI equivalent to earnings before interest, taxes, depreciation, and amortization, or EBITDA. For tax years beginning in 2022, ATI is defined as taxable income before interest, generally making ATI equivalent to earnings before interest and taxes. And that's going to severely limit the amount of interest expense that renewable energy projects, if they're leveraged, can take and claim. Under the CARES Act, the limitation amount increases from 30% to 50%, so some relief there for 2019 and 2020. Partnerships, however, remain subject to the 30% limitation for tax years beginning in 2019. In addition, all taxpayers, including partnerships, may elect to use their ATI for a tax year beginning in 2019 to compute their Section 163J interest deduction limitation for the tax year beginning in 2020. And I'm just going to go ahead and mention here that there are several other provisions of the CARES Act that are not included in this presentation. This includes some of the employee retention credits, the payroll tax deferral options, and also the Paycheck Protection Program, or PPP. There are also some emergency lending programs for larger corporations. And if you want to learn more about some of these programs, I'll just refer you to the Moss Adams COVID-19 Resource Center. And I think there's at the end of the slide, there's some links to some of these resource centers. Anyway, there's a mountain of guidance being published almost daily to help taxpayers navigate through these programs. They're complex and a lot of uncertainties in them. And so many of these programs, they just were enacted so quickly that they weren't completely thought out by Congress. There just wasn't time to really figure out all the details. And so Treasury has been left with the task of trying to fill in the details. And we see that information and guidance coming in a tsunami of, at us. So you need to be aware, you need to be constantly looking at the guidance, and hopefully there's enough resources out there that you can find those resources to answer your questions. Okay, here we have another polling question. I think this is our second one of 4. And I'll go ahead and turn that time back over to Julie.
Perfect. So second of 4, under the CARES Act, NOL generated in 2021 can be carried back to which year? A, 2020. Wow, we've got all the way up to G on this one. B, 2019. C, 2018. D, 2017. E, 2016. All of the above is F, and G, none of the above. We'll give you some time. Don't forget, once again, I'm sorry I keep saying this, to hit the submit button. But Eric, I wanted to chat with you during this Q&A while everybody's getting their CPE credits in. We had a question come in, and maybe I'll start by answering what I think, and then you can start by answering what you think. But the question, it was on electric vehicles, and the question was, when do you think that the technological limitations for electric vehicles will be overcome so that EVs are both price competitive and with combustion engines, and will have the same range? So are we going to need to switch from that lithium-ion battery? And I guess, I think that's a really interesting question, because I think that from an economic supply-demand kind of thing, you are going to have that happen. I personally see that occurring in the next probably 5 years, especially with the what California has done in saying that they're only going to sell electric vehicles. I think that's going to have to push the technology and the markets forward faster than probably would have been done. Kind of like with COVID, when we all knew we could kind of work remotely, but man, we've definitely progressed to a period of time that we wouldn't have been able to progress with the virus in that respect. So that's kind of where I think this is being pushed. I would guess probably that 5-year mark where it becomes very price competitive. Eric, what are your thoughts on that as well?
I mean, I'm not an engineer, and I'm not really familiar with all the text, but I am familiar with the arguments, and I guess I was kind of in that camp as well for a long time. But I do see 2 trends that cause me to think that this really is not going to be the major issue. One is, even with some of the economics, the social responsibility demands, they're going to overtake that or push the economics. So the economics aren't necessarily the only driver in this one. Social responsibility is going to drive this. The other thing is what you mentioned. There's going to be governments that are going to enforce these kinds of changes. And because of that, we're going to just see, you can just see what's coming. You can see an electrification of transportation, and that's going to happen. Is that going to happen the next couple of years? I don't know, but it's going to happen. There's eventually going to be a ban probably on gas-powered cars. I think all of the large automakers are basically trying to play catch-up right now with Tesla, and most of them are really trying to focus their efforts now on EVs going forward. So there's going to be the social responsibility, social impact of doing that, and then the infrastructure with some of the state mandates. That's just going to drive this stuff forward. So I don't know exactly when the technology catches up, but I think some of the other factors are going to play into that, and it's going to drive this thing faster. So
I agree.
Those are my thoughts.
Absolutely.
There. Yeah.
Thank you. And don't forget, if you do have any questions during the course of this presentation, throw those in the Q&A function, and we'll try to get to as many as humanly possible during the course of this presentation. Eric, want to debrief on this?
Yeah, okay. So this was kind of a trick question, I guess. One, 50-50 by it being all of the above or none of the above. In this case, it's none of the above. Under the CARES Act, NOLs generated in 2020, so 2018, 2019, and 2020 can be carried back. And NOLs generated in 2020 cannot be carried back. NOLs that are generated next year, they can only be carried forward, and they'll be subject to the 80% limitation. Okay, now we're going to go through kind of a refresher of the Section 48 credit and also the Section 45 credit. And we'll talk about the current status of these renewable energy credits under the code. The Section 48 energy credit was originally a 30% credit, and it was 10% for certain energy property. And that applied before the step down that we're going to discuss below. And it applied on eligible solar equipment that uses solar energy to generate electricity and that is placed in service by the taxpayer owner of that equipment. The original use of the eligible property, whether acquired, constructed, reconstructed, or erected by the taxpayer, must have started with the taxpayer. Under the PATH Act, the ITC was mostly limited to solar equipment, but the Budget Act extended the PATH Act provisions to the other traditionally eligible energy resources, including geothermal heat pumps, fuel cell property, qualified microturbine property, combined heat and power property, and qualified small wind energy property. ITC eligible energy property generally includes equipment that is tangible personal property and that is integral to the proper functioning of the qualifying facility. The basis of eligible solar equipment is then reduced by 50% of the credit claimed on the equipment. That's otherwise known as the haircut. And accelerated depreciation and bonus depreciation can be claimed on that reduced basis. The credit is subject to recapture provisions, whereby if the property is sold or ceases to be eligible energy equipment within 5 years of its place in service date, the credit is recaptured at a rate of 20% per year for each year the property is no longer eligible for the credit. On this slide, we have a couple of tables. The first table is the recapture rates and how that works for property that no longer qualifies as energy property. And we also have the available bonus depreciation rates. And looking at the depreciation rates, you'll note that the 100% bonus provisions under tax reform begin a phase down after 2022 for 5 years. And that's a 20% reduction each year. The Section 45 Renewable Energy Production Credit applies to energy produced by a qualifying facility and sold to a third party and is generally available for a 10-year period beginning on the date the qualifying facility is placed in service. Traditionally, the PTC applied to wind, closed-loop biomass, open-loop biomass, geothermal, landfill gas, municipal solid waste, hydropower, and marine and hydrokinetic equipment. Under the PATH Act, the PTC was mostly limited to wind, but under the Budget Act, the PTC was again extended to these other resources as well. For open-loop biomass, small irrigation, landfill gas, trash, hydropower, and marine and hydrokinetic equipment, the PTC rate is reduced by 1/2. For certain facilities, the PTC is available for a 5-year period instead of the 10-year period. Qualifying projects can elect the ITC in lieu of the PTC. You can elect one or the other. You can't do both. And this election continues to apply to projects whose construction begins in 2020. On this slide, we're going to talk about the step down. And this is a summary of the PATH Act, the Budget Act, and the Extenders Bill. The ITC rate for projects whose construction begins in 2019 is 30%. Again, that's for projects, the construction of which began in 2019, and those projects must be placed in service before 2024. For construction of a project and the construction begins in 2020, the ITC rate is 26%, and again, that project must be completed by 2024. Many of you on this call are probably familiar with some of the safe harboring that is occurring, and the idea there is to try to grandfather your project into, let's say, 2019 or 2020, and there's various methods for doing that to incur the cost and to basically say you've started construction, and that's to grandfather into these better rates in the earlier years as the ITC steps down. For 2021, for a project whose construction starts in 2021, it's a 22% rate, and for 2022, it's a 10% rate, and for years after that, it's permanent 10% rate. The PTC rate for projects whose construction begins in 2019, the rate is currently, for 2019, the rate is 40% of the credit that is otherwise available. So in 2019, the index PTC rate was 2.5 cents per kilowatt hour. So at 40%, that means that the PTC rate is 1 cent per kilowatt hour. And for 2020, the PTC had originally expired, but under the Budget Act, the credit was extended for 1 year, and the rate jumps back to 60% of the otherwise eligible credit. But that step up actually only applies to wind. So this slide, again, is just a visual representation, a graphic summarizing the ITC and PTC step down. It also shows the step down for PTC eligible projects that elect to claim the ITC in lieu of the production tax credit. And here, just note on the very top bar of the graph, that you can see that for wind projects electing, for wind projects that, you know, there was a phase down to 40%, and actually for 2020 that steps up to 60%. Okay, we've got another polling question, and I'll go ahead and turn the time over to Julie.
Perfect. So again, this is number 3 of 4, and our question is, what is the ITC rate for a solar project whose construction begins in 2021? Is that A, 30%, B, 26%, C, 22%, and D, 10%? And once again, I sincerely apologize for keep saying this, but hit that submit button. You do need 3 of 4 of these in order to get the CPE credit. if you want it, and I'm guessing that some of you do want it since it's close to December 31st, so it's time to get that last CPE end of the year. So we don't have any more Q&As right now, but again, reminding you that if you do have any questions as we go through this, please feel free to chat in the Q&A box and we'll get those questions answered. Take a few more seconds to get the answers to this question. Eric, before we get to that, to the answer to this question, do you expect to see more activity for some of these, something like a production tax credit or something, something new, perhaps, coming in the future, just based on kind of where the Biden campaign and everything is going?
I mean, there's a lot of uncertainty around that. There's a lot of interest, and these were popular. They kept the investments going, and as the phase downs started happening, we did see some less activity there. So the kind of the history with the credits is they're enacted, they have a limited life, and as that limited life creates uncertainty, less investors started investing in it. So anytime that you see the phase down and go away, that just has an impact on the levels of investment. And that's really not the direction we want to go in. So I do think there is, and we'll talk about this in the next batch of slides that we're going to go through, some of the proposals and what maybe is the interest level and and what kind of support there is for future incentives, either being extended or expanded or even made permanent. And we'll talk about those. President-elect Biden has made some indications in some of his proposals about that, and we'll talk about those in the next batch of slides.
Excellent. So let's go ahead and get the polling results. And Eric, I'll turn it back to you.
Okay, good. This one looks like most people guessed right on this one. It's a 22% rate for construction for projects whose construction begins in 2021. Okay. Now that we've been kind of refreshed on the current status of where we are with our, the current legislation, let's get into some of the specifics of what is expected from a Biden administration from a tax policy perspective. Of course, the Biden administration, I think everyone is expecting it to be more supportive of the renewable energy sector. President-elect Biden has proposed spending $2 trillion to combat climate change and eliminating carbon emissions from the power grid by 2035, and either extending the expiring renewable energy provisions, making them permanent, or, as we mentioned earlier, making some of those credits potentially refundable. And that will be a significant focus of the spending. Making the renewable energy credits refundable is a panacea to the renewable energy sector. Making the credits refundable significantly expands the investor pool, since monetization is not dependent on having tax appetite or having significant amounts of taxable income. A Biden administration's renewable energy related priorities will include extending the federal tax credit and, again, making them potentially refundable, reversing many of the tariffs and Trump administration trade policies that are seen as unfavorable to the renewable energy sector. On the other hand, there are many that do expect Biden to continue an aggressive stance towards China. And so it's possible that some of those Trump tariffs may not be immediately repealed. And then streamlining and permitting the permitting process for renewable energy projects. And I think that would be, that's probably one of the more important things, is just making sure that these things can happen and the permitting process can move forward without getting bogged down in red tape. Of course, some of the factors to consider whether any of these priorities can become reality include, we've got a divided government, and to what extent a Biden administration can move on any of the priorities is really uncertain, especially if we continue to have a Republican Senate. Behind closed doors, there does appear to be bipartisan support for some limited extensions of those credits and other incentives. And at the very least, I would say an overall infrastructure bill, which would most likely benefit the renewable energy sector, I think most people do expect that we will get, you know, an infrastructure bill. There's bipartisan support for it. Probably has a good chance of getting passed. In the near term, obviously the focus is going to be related on anything pandemic related, any stimulus pandemic related. And of course, this has the highest and most realistic chance of happening. If you're following the news, you know, it seems like every day they're saying they're getting closer and closer to, you know, at least a framework for this next round of stimulus, which I think they're now honing in on just under $1 trillion, so 900 billion or something in that neighborhood. So again, at this point, there is optimism that we can see some favorable legislation and at least some stimulus. And if the Democrats can ultimately win control of both houses of Congress, then the renewable energy sector will likely see more of these priorities come to fruition. In these next few slides, we're going to compare the current law with some of Biden's initial tax proposals. We'll look at business tax proposals, some international changes, and then some of the personal income tax proposals. Under tax reform, the current corporate tax rate is 21%. The move to a 21% tax rate was viewed as crucial for U.S. global competitiveness and was consistent with the reduction in corporate tax rates that is occurring in many developed countries, like the UK. Some of these countries have gradually been decreasing their rates down into this neighborhood, some even lower, into the 18% range. Biden is proposing raising that rate back up to 28% and instituting a 15% minimum tax for corporations that report more than 100 million of annual book income. This alternative minimum tax or minimum tax would function very similar to the alternative minimum tax that was repealed for corporations under the tax reform. Of course, a 28% corporate tax rate will put pressure on U.S. companies' profits and competitiveness, but there could be a silver lining for the renewable energy sector. And that is because, you know, tax attributes from qualifying renewable projects are generally more valuable to tax equity investors that are in higher tax rates. So the higher the tax rate, the more valuable the deductions are and other attributes. President-elect Biden has vowed to reverse most of the Trump tax plan that benefited taxpayers earning more than $400,000, including the 20% deduction for qualified business income, or QBI. And he has vigorously stated that he will not raise taxes on folks with incomes less than $400,000. And we'll just see if he's able to keep that promise. As noted in the table on an earlier slide, the current 100% bonus depreciation provisions from tax reform are eligible through 2022. And then they start phasing down 20% each year for the next 5 years. Biden is also proposing a 10% penalty surtax on the profit from any production by U.S. businesses overseas and for sale in the U.S. He is proposing instituting a 10% Made in America credit for companies that create jobs or increase manufacturing wages above the pre-COVID baseline. He is also talking about enacting the Manufacturing Communities Credit that promotes revitalizing, renovating, and or modernizing existing or recently closed facilities. And his proposals also include expansion of the Work Opportunity Tax Credit. Biden also wants to expand the New Markets Tax Credit as well and make it permanent. He is also proposing to end fossil fuel subsidies, and that includes ending the deduction for intangible drilling costs. In addition, Biden wants to reinstate or expand the various credits designed to reduce carbon emissions, many of which were discussed above when we talked about the ITC and PTC. He is also proposing to remove the like-kind exchange deferral. This is the tool that most real estate developers, like Trump, have successfully used to defer their tax bills, and it's been used for years. Expansion of the low-income housing credit creating a one-time $15,000 tax credit for first-time home buyers, and creating a renter's tax credit for low-income families. Related to U.S. taxes on global income, Biden is proposing to raise the GILTI rate to 21%. At this time, we're not going to get into a lot of the GILTI mechanics. If you are interested in learning how the GILTI works, I'm going to refer you to the Moss Adams Resource Center, and on there you can find lots of articles and guidance on the GILTI, how it works, and the purpose of the GILTI. Biden also supports a clawback provision designed to force companies to return public investments and tax benefits when companies terminate jobs in the U.S. and send them overseas. There really aren't too many more details on how this clawback provision will work exactly at this time, but that is something that probably does make some sense. Okay, in the next couple of slides, we'll go over some of the individual provisions and see how the Biden tax policy might affect each of you personally. Under tax reform, the highest marginal tax rate was reduced from 39.6% to 37%, and Biden is proposing to raise the top marginal rate to the pre-tax reform rate of 39.6%, but only for incomes in excess of $400,000. He is proposing to remove the preferential rate for capital gains, currently 20%. There's an additional 3.8% additional tax for based on the net investment income tax, making it effectively 23.8%. For individuals with incomes over $1 million, those favorable capital gains rates won't apply. And in this case, capital gains would be taxed at the ordinary rates plus the net investment income tax. That would mean a top federal rate as high as 43.4%. And when you throw in state taxes on top of that, you're talking about rates well in excess of 50%. Currently, individuals in the 37% tax bracket enjoy an itemized tax deduction benefit of 37% for their itemized deductions. If you're in a lower bracket and you have itemized deductions, then the value of those itemized deductions is only the value of the bracket you're in. So the lower the bracket and tax rate, the lower the benefit of those itemized deductions that you get. So Biden is proposing to cap the value of an itemized deduction at a 28% value. So if you're in let's say the 39.6% bracket, the value of that itemized deduction to you won't be 39.6, it'll be 28%. Basically treating it more like a credit. And the purpose of that is to try to equalize the value of these itemized deductions across, for all taxpayers. He's also proposing to restore the overall itemized deduction limit, and he generally supports eliminating the cap on state and local itemized deductions. So removing that cap on state and local itemized deductions is encouraging, especially if you're in a high tax rate such as California. Of course, in California, there are proposals to increase the state rate to as high as 16.8% for wealthy taxpayers. So you're really quickly getting into that 60% potential range as a top rates. For estate and gift taxation, the current lifetime exemption is approximately $11.5 million. This means that a deceased person can pass on his estate with a value up to $11.5 million before he incurs the inheritance tax. The $11.5 million exemption is scheduled to revert to the pre-tax reform indexed amount of $5 million after 2025. Also, under the current and historic rules, inherited property on death gets stepped up to fair market value. Under the Biden proposal, the step up to fair market value on death would be eliminated. His proposal includes reforming the Qualified Opportunity Fund rules to focus on creating jobs and development of low-income families. There's some other things for dependent care, credits being increased. You can kind of read through these things. I know we're running short on time, so I'm going to get through these last couple of slides very quickly. Biden's proposing canceling student loans tax-free after borrowers are enrolled in an income-based repayment plan for 20 years. So after 20 years of being on an income-based repayment plan, the student debts would be forgiven tax-free. If you perform national or community service, you can also have $10,000 of student debt relief for every year of service for up to 5 years. And then the whopper. Currently, the payroll tax rate is 12.4%, and it is applied on wages up to $137,700. Wages in excess of that amount are currently not subject to the 12.4% payroll tax. The 12.4% payroll tax is shared evenly between the employer and the employee. Under the Biden proposal, for those earning more than $400,000, the cap is removed, and all wages above $400,000 would now be subject to the 12.4% payroll tax, and again split between the employer and employee. This could potentially be a massive tax increase on individuals making in excess of $400,000. Of course, some of these proposals are not wildly popular, even within the Democratic Party. So it is likely that some of these provisions will not make it into any final tax legislation. There's also a handful of other provisions referenced in the slides, and again, we're not going to get into these at this time. And if you'd like more information or have specific questions about any of the things not covered in this presentation, please refer to the Moss Adams website for additional resources. Okay. We have our last polling question, and we'll turn it over to Julie.
Perfect. So in our last polling question, Biden's tax proposal includes an increase of the federal C corporation tax rate to A, 35%, B, 28%, C, 22%, or D, 18%. We want to take this time quickly while you are submitting those questions to thank you for being here today. And obviously, I think one of the things that we want to stress in this is that's a proposal that's been made that we've heard about. However, the reality of what's going to happen will take months, if not years, to come down the pipe. So again, that's why we say stay tuned. Obviously, not everything is going to happen according to this proposal. And as we had a participant say, we did keep saying President-elect President-elect for Biden, and he hasn't been termed the elect yet. So we understand that. We do see that this is probably going forward as far as there will be some tax changes coming up in the next several years. But it will be a stay tuned, and a lot of this will depend too on what happens in Congress as well. So you can see that it's a pretty significant package, and hopefully one that's going to help the renewable energy. Though I think on the business side of it, it has some complications as well. Amy, do you want to go? Perfect. Eric?
Okay. Yep. Looks like that everybody got that one right for the most part. I'll just say one thing. It's basically, as expensive as all the stimulus has been and the packages that have been, set forth, you can expect someone's going to have to pay for that. There's been unprecedented amounts of stimulus, and that's really, you can just expect that tax rates are going to have to go up across the board at some point. So anyway, that is the end of our presentation. And I don't have anything else. Again, if there's questions or that you might have, please refer to the website. And I think at the end, at the last slide, there's some links that can show you some of our resource centers. And I just want to say thank you for everybody, and have a good rest of your day.
Right. And Amy, we're going to turn it back to you. But again, thank you for everybody being on the call, and just stay tuned. There's a lot that's going to happen over the coming months. And so we'll make sure that these resources are posted to our pages. Webinars will be coming available to give you those resources as quick as we know them. Also want to put a shout out for, I know this is the tax piece of it, but we do have a year-end financial reporting for energy companies webcast starting on December 16th, and that's available on our website. So Amy, I'm going to turn it back to you.
All right. Thank you, Julie, and thank you, Eric, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, You must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey as your feedback is very important. Thank you for joining us. We hope you'll join us again next time.